Thank you so much for joining this afternoon. For our 2021 market summary, I'm joined with Peter Watson, and we're going to be discussing what's happened in the market, as well as tying in what the market returns, what all the graphs we're going to put on the screen, what all of that actually means to end investors. And for more information about how specifically the markets affect you, please reach out to your wealth manager at Watson Investments. And for all prospective clients, please reach out to myself. Be happy to have a conversation. For anyone listening, if you have any follow-up questions, want to see a slide again, any questions about this presentation or just markets, investing, financial planning in general, myself or Peter are happy to have a call, Zoom, or email with you. So please feel free to reach out. Be happy to hear from you. One of the most talked about topics last year was inflation. The cost of living adjustment in Ontario was 4.7% increase last year. That's very high, and it's higher than the average. And so for some people who are employed, that might have resulted in an increase in your base salary, although most employers did not go the full 4.7%. The average was somewhere in the 2% range, and it would have depended on roles, companies, everything like that. But it did bring a lot of heightened awareness to the topic of inflation, which is a very important topic. We're not going to experience hyperinflation in all periods of time. The average, like I said, it's much lower than what we've experienced this past year. But it is a very important thing to consider. It really does impact our planning. So when we're planning for the future and when we're looking at investment returns, we need to understand what that actually means for throughout our life, throughout the years of retirement. And inflation is a huge factor. So we're going to talk about inflation throughout the presentation and relating it back just to try and add more value for such an important topic. And basically, I would say the most important and the most talked about topic in kind of financial planning this past year. For any of our clients, you are talking about inflation, how it impacts your portfolio. You're doing this in multiple ways with your advisor. You're tying it all together in those cash flow projections that you're doing. We encourage it at least once a year and more frequently as you need it. And for any prospective clients or clients, your friends, your colleagues, your family, please let's connect. Let's have that conversation. You can go to our website. The top right-hand corner has a free consultation button. You can actually click that, book a meeting directly with my calendar, and find a time that's easy for you. And please stay connected. Clients, you are receiving our newsletter. So when you receive our newsletter, you're going to receive relevant updates to the company, what's happening in the markets. You're going to get Peter's articles. He writes a weekly column, and other resources and webinar invitations. Prospective clients or people who are just interested in learning more, please also feel free to sign up for our newsletter. You can go to the bottom of our homepage on our website, and there's a sign up tab there that you can just sign up directly. As well, we also have Instagram, YouTube, Facebook, and LinkedIn, so please follow us on social. Really love to stay connected with you that way as well. So what happened in the market in 2021? Well, when we look at some of the returns, we see ultimately relatively positive numbers for most of the areas that we have up on the screen here, and very strong positive returns. So the Canadian stock market, over 25% US, over 24% return. International, over 10% return. Emerging is where we saw a decrease, and in the Canadian bond market and the global bond market, just as some of the areas that we're examining on the screen right now. And those were negative returns. And then we have the global real estate was also a very positive, over 30% return.
And Jennifer, while we're on that slide, I'd like to just highlight for clients that have been working with us for a number of years, you know how passionate we are about diversification. Diversification is the investor's ability to make their portfolio safer. You don't know what's going to happen in advance. And so what you want with diversification is you want some assets going up and some assets going down. Now, if we could predict the future, we'd only invest in the ones that were going to go up in the next year, but you don't know. So you want to have a bunch of different assets. And hopefully when you have losing categories of your portfolio, that will be offset by other categories. So the fact that some arrows are going up and some arrows are going down, that's really what you want in diversification. You want to be sort of spreading your risk, managing your risk, and being proactive to avoid, steep declines by over concentrating your portfolio in one area.
And what's really important is that, assessing that balance between the geographical geographical investing. Peter will speak more to that in a few moments, and figuring out the best asset allocation that's right for you. So what's the mix between stocks and bonds? When should you be rebalancing? What is the best fund choices for you? And all relating back to your individual risk, but circumstances, lifestyle desires, all of that must be considered when you're investing. So it's not just the returns. Like Peter said, it's not just looking at the return and, jumping from, well, US stocks perform better than international, so maybe we should move all into US stocks next year. That's not a strategy we want to pursue. What we want to be doing is we want to be not chasing past performance ever, but really looking at the evidence of investing. Where have premiums shown up? Where have the returns shown up? What is going to help you achieve your goals? Managing the risk and your comfort level with the volatility that we can experience in the market. We want to target it there. When we speak about volatility, let's take US stocks as an example. The best year return was over 41%. It's very strong. The worst was a negative 22%. That's a big decline. But what we see is the average yearly is over 10%, which is a great return. So this past year was more than the average yearly, phenomenal year. But that's some of the volatility you can experience looking at the US market. If we look over to the fixed income, you're not going to experience that level of volatility. And the next slide, I think, will really help articulate that.
Yeah, and before, just one final thing, go back to that last slide, and just one final thing, if you'd circle the Canadian stock on the top left, a little bit of proud moment for Canada. Our stock market performed the best, even better than the United States, which is terrific. We look at these numbers, but we don't take these short-term numbers to develop portfolio designs, because that doesn't work out. For example, the reason I'm pointing out the Canadian stock market being so good, if you look at the logic of investing in Canada, we're a really small country, a bunch of oil stocks and materials. We're a very concentrated economy versus, say, the States or the rest of the world. The Canadian stock market compared to international investing has been significantly less attractive over the past. Plus, it has had higher volatility. When you have a concentrated position in energy and materials, of course, the swings of the market, and that is a very volatile market, are going to be more volatile. So that's why we have diversification, and that's why we have very strong diversification, including the rest of the world other than just our home country. Okay. This is a lovely graph, and the reason we've got so much detail is some people might want to watch this webinar again and look at more of the detail. We're just going to highlight two figures.
We are, and to that though, we are recording this webinar, like all of our presentations, or 99% of our presentations. We do record them. We put them up on our YouTube channel after the fact. They also get sent out in the email. So if you're on that newsletter, you'll get that prompt. You can also find them on our website under the events tab and the archived items.
Okay, so over the last 30 plus years, starting back in the early 1990s, if you had $10,000 and you invested entirely in a bond index, looking at that as a proxy for bond values, your $10,000 would be up to about the mid $30,000 range. If you had invested 100% of your assets in international equities, that same $10,000 would have grown to $130,000. as Jennifer is going through the ups and downs of the market, realize, yes, it has done better over time, but realize it comes with a whole lot of volatility. And I think, Jennifer, you're going to perhaps address this a little bit later on. So there are different kinds of investments you can have, all the way from 100% concentration in equity, 100% concentration in bonds. They're gonna give you different things because they're different investment vehicles.
So when we're looking at what is the best asset allocation for somebody, why wouldn't we just choose 100% equity if we're going to get a better return?
Well, that's a good question. If somebody, you have short-term needs and you have long-term needs. If you had a short-term need, for example, you're going to do a significant renovation in your house next year, you might want to put that money aside, because let's say you had $1 aside for your renovation. And let's say the bond market had a really lousy year. Well, a lousy year for bonds might be -5. So a year down the road, you're still going to be able to do the renovation, no harm done. But if you had all of your dollar in stocks, I think that last chart you said the US stock market was down, was the worst year was what, 30–40%. You know, if you had your $1 decreased by that much, then your idea of doing the renovation next year is off. So you really want a combination of short-term, long-term thinking. And our clients typically blend. We want to manage risk, but we want to also be respectful of the fact that your needs going down the road with inflation, as Jennifer, you started talking about that. You've got to keep up with inflation, so your purchasing power. And actually, before we leave this slide, why don't you just, I know we're skipping ahead, but why don't you just sort of review a kind of a conversation you might have with someone that's retiring, say 65 years old today, going to retire. Should they have all bonds?
Yeah. So retiring sometimes can trigger an asset allocation change, but it doesn't necessarily mean that we're going to increase the bonds in a portfolio. When you retire, let's say at age 65, you still have so many years in retirement. Based on the age of 65, what we do is we use Statistics Canada and the 10% chance of reaching a certain age. And each year, as you get older, that age can go up. And we project out to the 90s, actually, for both men and women. We can make adjustments, of course, based on your beliefs and circumstances. Some people will even go as far as wanting to, to project to 100 for that extra safety. And when you retire, you'll still have a huge time horizon on your hands. Yes, you might be needing some money from the portfolio in the near term, whereas you haven't in the past, let's say. But we want to take into consideration, what other sources of income do you have coming in, if any? How much are you going to want from the portfolio to meet your spending needs? And that's going to help us decide, what's that mix between stocks and bonds, because typically what we do is we take the income needs from the bond portfolio side of things and we rebalance the account as needed. So the right mix for you, it does truly depend on your circumstances, how you feel about the market, how we're able to coach you, to educate you around the market. When we're onboarding new clients, we ask them a very unfair question, I would say, at the beginning, because we ask around volatility expectations. And it's a hard question because I think without really understanding the backing to how much volatility can happen in portfolios to actually achieve good returns. So normally we kind of ask, but then we also do then a lot of education around historical returns to really provide that coaching, because we want to understand that volatility is needed. As long as we have a diversified portfolio in the right investments, that volatility most people need. Now, Peter asked about retirement specifically, and does that change with bonds? There are some people that have 100% equity throughout their whole lives. It's more rare to have that, but it is possible, and there are ways to do it without ever hurting the portfolio. So there's a lot of different options, and that's why looking at your specific circumstances, not just looking at these returns on the screen, is what's going to be the best way to proceed. Just moving to the next slide. There we go.
The one figure I'd like to highlight on this one is Canada, 3%. Jennifer, just bring the red dot over the 3%. Canada, as I said earlier, very small economy. And so it's quite normal, not for our clients at all, but it's quite normal when somebody comes in with their investment statements as a potential new client, that we say, well, why do you have so much money in Canada? You know, there's five major banks. You typically own 3 of them. Why do you have all that concentration? Humbly and respectfully, I think that's wrong. You need diversification, because Jennifer, when you were just talking about sort of long-term time frames and in retirement, you can have 100% of stock. If you had 100% of your portfolio in just 10 stocks, or 100% of your portfolio, the stock portfolio in just Canada, you're taking a lot of risk. But when you have, if it is in fact 100% or some large number in stocks, and you own 10, 11, 12,000 companies around the world, whoa, that's a lot of diversification. Yes, it's all equities, but your risk is spread over 12,000 companies. Very well managed risk in that regard.
And not only how many different positions you're invested in, but the different sectors, countries, that all really helps when we say diversification. That's what we mean.
Sure, different currencies, different political risks, just different. That's the whole joy of diversification. And you can get these diversified portfolios on a very low cost basis nowadays. So it's not really expensive to diversify. US, the giant, 60%, their percent of the world publicly traded companies has been increasing over time. That's a little bit misleading. It's a powerhouse, economically speaking. But some of their companies that are in the US, that do business in the US, also do a significant amount of business around the world. So if you own a US company, that doesn't mean you just have risk exposure to the US country. In the US economy, you've got, well, Apple, Microsoft, those types of companies. They do business in Canada, in Europe, in Australia. So you're really basically, a lot of the US stock market is really, could be classified under kind of a world category, which there isn't a world category. But just a heads up on that. And the next one is international. And so that's just the balance of, we've got Canada and the States, a fairly small chunk in international, and that'd be sort of Europe, Australia, and finally, emerging markets. Whoops. And finally, yes. You, Jennifer, started off by talking about the importance of inflation. It is very important, and there has been a lot of press on this topic, and there will be a ton of press on inflation, because the central bank has to determine what interest rates will be. The big question to investors, we're not the central bank, we're looking at it from an investor's point of view. The big significant part of inflation for you, the investor, is, will that hurt or help your investment portfolio? Should you be informed by inflation in terms of what you might want to do investments? And the answer is clearly no, not at all. Now, we can give you more detail on this. We did a recent article, a newspaper article that's on our website that talks about this topic in a bit more detail than we're going to cover today. But if you can see, Jennifer, can you highlight some of those red dots? The red dots, there we go. The red dots show inflation going up, going down, going back and forth, up and down. And the question is, does the level of inflation, does the rate of inflation impact the stock market returns? And the answer clearly is no. Regardless of whether the inflation is high or low, we have very high years for stock market. We have low years of stock market. It's basically kind of random. So don't be looking at your investment portfolio and trying to tweak it based on what you think inflation might do or might not do. It's proved to be sort of a non-event when it comes to investment returns.
What does matter, though, is looking at inflation affecting your portfolio. And it's one of the arguments to be made why we can't just have our money in fixed income. We'll look at a slide in a moment. Again, we've seen in the slide in other presentations, and it really highlights that where the inflation level really is, where the bonds would be, and how that's not enough of a return.
Yes.
So it's important, like Peter said, it's not important for the investment choice, but it's important for the overall asset allocation choice.
Yes. And if I can just summarize a really interesting conversation that we've had with, many clients over the decades. A lot of people want to say, okay, when I'm that age, in senior age, will I be living in a nursing home? Will we be living in a nursing home, a retirement home? And if so, how much will that cost? Short answer, it's going to cost a ton. They're very, very expensive. And so will you be able to afford it? And so in the cash flow projections that you said we encourage clients to do every year, which we do, and some more often than that if they have the need, we can say, all right, you might spend X number of years in a very, very expensive retirement home. And that retirement home might get more expensive, by more than the average inflation rate. So we can, with the computer, we can just in front of the client's eyes, we can tweak, say, okay, it might cost not $1 to live a day in a retirement home, it might cost $2 or $3 a day to live in a retirement home. Will you be able to afford it? Mm-hmm. And the cash flow projections with graphs, there's lots of numbers, but you can ignore the numbers sometimes. Just the graph shows you, yes, you will be okay, or no, you have to make adjustments now because X number of decades from now, you might be in a predicament.
Mm-hmm. So ultimately, the major question is, how are you going to maintain your lifestyle? And that's definitely the most important question. So how are we going to do that? Well, there's many different ways that we examine this for clients, and key things that we should be looking at. Well, the first we'll talk about is that capital markets, they reward investors. They work for us. So be invested in the right markets for you. Diversify, we can't say it enough, and trust the market. Have that right balance of asset allocation. When the markets have been so positive this past year, what we do notice is, there's sometimes less attention from investors on the portfolio. There's less concern. All of that makes a lot of sense. Whereas what we saw in 2020 with the major decline and then the volatility, we actually saw more people being focused on their accounts, which actually led to more movement in the market, led to us getting more clients than an average year even, which is great. And it's because there's that heightened focus. But even in positive years, it's still really important that we are still addressing these key things, because we're setting yourself up for the future of success. And we're also making sure that, for the next decline, we're well prepared. Your lifestyle is not going to be affected. We've planned for this, and we can rebalance. We can do tons of different things. So, but ultimately look at this is 1985, the growth of $1, lots of volatility here. But look where it's ended up in 2019. At the end of the year, that dollar has gone to $28. That's incredible growth. Whereas if we had only short-term world government bonds, it's maybe a better investment experience because we see our money almost always going up on an every year basis, and it's just doing that gradual increase. So sure, it's maybe a better experience. You're looking at your statement, you're never seeing a negative. But ultimately, it's not going to produce the best outcome. So that's why, earlier in the presentation, we showed you the different combinations. That's why lots of investors, especially at later stages of investing, will have some sort of combination of the two that makes the most sense, and then rebalancing accordingly of the portfolio and having those right investment choices is really going to serve you well. The other things we can do, so not only asset allocation, not only the investments, but the financial plan. The financial plan is something that should be ongoing. It should be constantly evolving. It's, once you've made a plan, that's great. But every year, circumstances change for your personal life, the rules. And what we do is we use a tool, Financial Planning Priorities. Clients, you guys have all seen this. You have this, and you use it with your advisors. And we outline, various areas that are very important, and we have the strategies written in the action column. And the strategies can, like I said, evolve, but this acts as a check and balance system for all of us to make sure we're on track to really achieving your goals. And some key areas here would be retirement planning and tax planning. Those are some of the two, I think, favorites of clients. And making sure we have the cash flow projections done. So important. We've talked about kind of many of the reasons why. Combating inflation, reducing fears of volatility, all can be done with the cash flow. We actually have the Power of Financial Forecast is a webinar that we did this past year in 2021. And you can find that on our YouTube channel. So if you go to YouTube and search Watson Investments, you can find that. As well, you can find it on our website. So if you go to our website and events and archived events, you can find previous webinars that we've done. We did a lot in the last over a year and a half. And so they're all there and you can take a look at those. The Power of Financial Forecast will just highlight more of the key details around cash flow projections, inflation, how it can really make you understand your current spending and your future spending. So even people who are in an accumulation phase of life, younger phase of life, it's still a really important tool to do because it just helps us put today's perspective. So it helps us tell, sure, if you can only save X dollars every single year, I understand this is what the future is going to look like. And sometimes people are in more expensive phases of life, which will lead to, we can only meet this minimum and it's not our real target goal to reach our retirement, but that's okay because, my kids are going to move out of the house. I'm going to maybe be in more of my peak earning years and I'm going to be able to save substantially more. So we want to do these, have these conversations. We want to tie it all back into the cash flow. Honestly, it just makes it an easy way to have that conversation because it creates visuals and just heightened understanding of our today's choices for the future. And really, in summary, is the key to success is having that financial plan, investing based on you and your needs, working with a team you trust, and performing those annual cash flow projections. So please stay connected with us. Sign up for a free consultation or invite a friend to on our website. Also, our newsletter, bottom of the homepage on our website. Sign up for that newsletter if you don't already receive it. And our next webinar is our quarterly market update on Wednesday, April 20th at noon. You can sign up from our website, events, upcoming events. Giving you lots of direction for website links today. Please just feel free to email me if you have any questions or would like anything as well. I'm happy to help. And we really appreciate your time today. Thank you so much. Look forward to hearing from you.
Yeah, nice to see you on the Zoom, on the webinar. Thanks for joining.